Hi, everyone. I'm Clyde Bryant, and welcome to episode 21 of the Uptown Experts podcast. I'm here today with Luigi Cirocco. Lou, welcome back.
Hey, buddy. Happy New Year.
Happy New Year. Is it
to be
still okay
back.
to say that?
This is a Seinfeld episode.
Yeah.
They covered this extensively. I got Happy New Year today. Do you believe that?
Well, it's true, right? Let's be real. I mean, it's what? Today's the middle of the month, almost 13th of the month. Yeah, I don't
Still
know.
get away with it.
I had this conversation with someone yesterday, and I'm going to say you got 2 more days left. After that, you got to cut it.
All right, I take it back then.
No, it's still valid. I'm just saying 2 more days, and then maybe you got to find something new. So anyhow, we're here today talking about renewals, right? We're talking about your mortgage renewal and the fact that it's not just about rates anymore. It's about really a financial strategy, a planning conversation, and making sure that you're going through and you're finding the right options for you and your family, really.
Yeah, and it's a big renewal year this year.
You're telling me.
So that's probably the context behind why we're having this discussion is because, what is it, like 60% of all mortgages in Canada are renewing this year, or some crazy number like that?
I don't know the exact numbers, but I know it's
unbelievable.
a lot.
But it's a lot. A lot of people are up for renewal this year, so I think that's the intention here, is to sit down and have a nice discussion about renewals and all things renewals.
Yeah. We're talking about debt strategies. We're talking about planning, and we're talking about why working with a broker matters, especially during these times. So why is this conversation more important now than it was in the past? If we're looking at rates, the fact that rates have shifted, or let's be real, rates have increased dramatically from our COVID days. And for those of us that, bought a home during COVID or renewed during COVID, you're probably seeing, high 1s, low 2s in terms of interest rates. And today, if we're talking about renewing into a 3-year product, which, let's just, a lot of the options we're looking at now are 3-year options. You're probably looking at rates where? Some low 4s, high 3s, somewhere around there.
Yep. Yeah, right about that.
And, if you're currently sitting at 2% and I'm sitting down with you and I'm saying, okay, Lou, your mortgage at 2%, you made you're going to say you kind of ran away with a crap ton of money there. And now you're doubling up on your interest rate. I know the conversations that I'm having, I feel like the frog in my throat when I'm about to say, so your interest rate's going to be 4%, right? And they're saying, well, what happens to my payments? And I think just understanding that's a conversation that we're having every single day. It's the reason why now we're having to do this, right? We're having the conversation, trying to break things down for everyone.
Yeah, so your question to me was, why is it more important than ever before? But you answered the question in your question, or a lot of it, in my opinion, anyway. So, yes, it's more important maybe than ever, because who are the people that are up for renewal now? A lot of them, a good chunk of them, are the people that bought in 2021, right? Because a lot of people took a 5-year term. Here we are 5 years later, and their mortgages are now coming up for renewal.
Well, it made sense to do, whether you were a variable or you were in a fixed at that point in time. Rates were just so low.
Yeah, and by the way, you could have just been renewing in 2021, which was a
100%.
fantastic time if your renewal came up then. So
Bet you thought you were smart then.
So a lot of who's up for renewal today is someone who either bought or renewed their mortgage 5 years ago in 2021, which, well, what was going on in 2021? Besides all the circus of life, let's talk about the real estate market.
Yeah.
Rates were artificially low, as you said. Some people have rates that start with a 2. Some people even have rates that start with a 1, by the way. So rates were artificially low, and great. Been a good 5 years. They've hopefully paid down some of their principal.
It's been fantastic.
But what else has happened? I mean, in the last few years, we're not going to do a podcast here about inflation.
No, we're not going down.
But I'm gonna just say life got a lot more expensive.
Yes.
The reins were tightened for a lot of people, and if things are already tight, with you having a mortgage that's at an artificially low rate, let's say, well, what's coming? What's coming is the shock of a lifetime, where, as you said, rates now are
Payment shock.
4%.
Yeah.
And, if you got a $500,000 mortgage at 2% and now you're at 4%, that's a huge jump in payment. So budgeting becomes important. Looking at your whole picture becomes important, maybe more so than ever, as you touched on. It's not just, what's my bank offering me this time around? Let me review the options.
No.
All right, I'll tick this box. Maybe I'll call them, and, maybe someone's in a good mood and will give me a touch better. But it needs to be so much more than that now, more than ever again.
100%. I mean, I'm not going to, sit here and do the math, but if someone has $1 million mortgage and they're at 2% today and they're at 4% tomorrow, that $20,000 that is going to be pure interest that they're going to need to find a way to pay over that course of that year, bad math, it's going to impact you. And I don't know very many people that can just turn around and say, okay, well, I'm going to find an additional blank $1,000 a month.
And in some cases more than that. The bigger the mortgage, the bigger this impact is going to be to the
100%.
To the person that's up for renewal.
Now, let's talk about that, though, because I know a lot of people during COVID said low interest rates, bigger home.
Borrow more, stretch myself.
Exactly.
For sure.
But now what they're seeing is big mortgage, high rate. No, and you know what? Let me take that back. It's not high rate. It's higher than it was. But like you mentioned, it was artificially low. So where you now have a rate that starts in the 4s or potentially high 3s, we're talking about impacting your life, really. Your cash flow. What does that mean for your family? What does that mean for you, for your financial future? People go out and buy cars after they buy a home. Are you going to be able to afford that car, that home, whatever that is?
They've also gone up a lot in the last 5 years. Life has just gotten very difficult. And then you add in the fact that you've got insecurity with the job market. The economy's slowed right down. So people are scared. People are... But you have to renew.
Yeah,
not you have to renew, but you have to deal with your mortgage coming up for renewal.
Exactly.
And you have to make some kind of a decision. It's not just look the other way and it'll go away. You have to do something. So people are nervous.
Well, I think they're nervous because they're not planning ahead. And, unless you lived under a rock the last 12 months, and I'll be generous and say 12 months, everybody knew rates went up.
Sometimes, though, when you get bad news,
you choose to ignore it.
Exactly. It's coming.
So it's like I won't say it, but la 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 la. I'm not listening, right? No, that doesn't work.
we deal with human beings in this business, in this industry, so that there is that sometimes.
Yeah, but you're talking about your single biggest investment, and now when you're forced to look at the full financial picture, for some it's ugly. And so let's talk about options. Let's give them that, right? Yeah. So I heard you say earlier, you're not going to just call the bank and hope, but it's not just about, I'm going to say, picking a rate anymore. It's about planning, right? So let me explain. When someone picks up the phone and calls us today, and they are saying, hey, Lou, hey, Clyde, my mortgage is up for renewal, I can guarantee you that we're not saying, okay, yeah, no problem. Let's just take a look at that offer, click the box, and send it back. Because 90% of the people, and you know what, I'll take the number back. But for many people, it's not that simple anymore. It's about looking at their overall financial picture. Has debt been racked up? Is there credit cards, lines of credits, loans that they've taken out in order to simply survive because of the inflated costs of living? And it's not just renew. It might be refinance. So talk to us about that. What does that look like?
Okay, well, the number one advice I would give to somebody if they're coming up for renewal is, first of all, start early. Your renewal might be February 1st. That doesn't mean you have to wait until January 15th to contact your trusted mortgage professional. Start early. I had a friend of mine a couple weeks ago reached out to me for his renewal, and I leveled with him. I said, man, I wish we would have talked 3 weeks ago, because number one, I'd have more time to look around for you, find you a solution that made sense. And number two, the offers that were available were a little bit better. So start early. It won't hurt you, right? If rates, or again, we're not going to make this about rates, but if the offers that are on the table aren't the best they're going to be, then they'll only get better. They won't get worse, but at least we'll have something for you as a baseline to start.
Yeah.
If you start in the last minute, the offers that you're being offered are just, they're what are out there at that point.
Yeah. So to your point, we want to ensure, that people are starting at least 120 days before, right?
Yeah. I usually would tell people 6 months, start thinking about things and let's connect.
That's the original conversation. That's the planning conversation.
Well, and that's where I was going to go next. Is it's not just start early because of the offers that are available. It's start early because I want to know what's going on in case we need to rearrange things, in case we need to pivot, in case maybe we have something we have to deal with that takes time, pay down a debt, get yourself off of a vehicle loan, something.
Look at that credit card debt. Student loans is a big one for people that are renewing now.
Yeah. I know we're going to talk about this later, but possibly cosigner. Do we need to go down that road? Do we need to involve family in a discussion? So start early, because it gives you the time you need to ensure that everything is in order in time for your maturity. Because I can tell you, a lot of people in the past that I've spoken to, number one, there's this misconception about maturity. They feel like it's like the be all end all absolute deadline. I don't have time. Like I'm going to renew for a year. So I've heard that many times before. And I'll just clear up a misconception out there. For the most part, if you're with a bank, a prime lender, just because your maturity date is Thursday, it doesn't mean you're not able to do something, even if you started late.
Yeah.
Because most will allow you to renew into an open.
Exactly.
And
Take the high interest rate open, whatever that might be.
Higher rate,
but it gives you flexibility.
But it allows you to pay that mortgage out a week, 2 weeks, 3 weeks, however much time we need later, and put you in the mortgage that makes more sense for you. Don't feel like, oh, I left it late, my maturity's there, my bank's calling me. Of course they're calling you.
They're doing their job.
They need to renew you. So they're going to hound you and say, hey, you have till this day to sign my document. Otherwise you're going to lose this offer I'm giving you. So it's not the end of the world if you're with a bank. And there are exceptions, which I don't want to make this about that. But again, start early. We avoid all this. So that's above and beyond anything else. Start early would be the first piece of advice that I give.
I think he said that a few times.
Start early.
So what happens if your home value has dropped and you're underwater? That's a tough spot to be in. So what does being underwater really mean? And what advice would you give someone that's in that position?
Okay. Yeah. So start early. We're going to because I want to have a discussion about everything that's going on, right? And that's going to include what's going on with the house, the house value in a lot of cases. So what to do if you're underwater? Underwater meaning I bought the house,
$1 million.
paid $1 million. It was when the market was just steaming right ahead.
Yep.
We're not at that place anymore, sadly, especially the condo market. Maybe today the property's not worth $1 million anymore. Maybe if it gets appraised today, it's worth 900, 850. 750. Wow, you're a pessimist over here. Let's hope not. But it could be, right?
Yeah. You said condo, so I'm just,
depending on when you bought, where you bought, what type of property you bought, there's a chance that based on the timing, your home's worth less than what you paid for it.
Yes.
Now, if you are making your payments and you have a low loan to value, so if you put 50% down on $1 million, yes, your value took a little bit of a dip, but overall, you're not what we would call underwater.
No real change there. Continue doing what you're doing.
Yeah, and just keep, you can keep going and still move your mortgage. No, life goes on. You're going to be annoyed, of course, because most people view their house as their biggest asset or investment in a lot of cases, and they think, oh, well, it took a little bit of a haircut on value, but really, you're in it for the long run.
It doesn't matter
I
because you're
wouldn't
not
sweat
selling
it too much.
Yeah.
Now, the people that maybe are really concerned are the ones that perhaps they borrowed 80% or more.
Or,
right?
yeah.
They could have bought it.
They put 20% down, they bought $1 million home, got an $800,000 mortgage.
And now the house is worth, in your example, Mr. Pessimist, $750,000.
Yeah.
It happens.
It's real.
And I mean, even if it's worth $850,000, I would still call you underwater because your loan to value is upward over 90% at that point, right? So what does it mean for that person? Well, not really too much unless you are trying to sell. So that person can't really move.
No.
The latter buyer, they're maybe stuck for a little bit until the value goes back up. But if you have to deal with a renewal in that time, you can still do so. So what I would say is there are cases where we can help, and maybe there's cases where we can't.
There might be cases where it makes sense to say. Yeah.
Don't assume. Let's have that talk, because we do have people that think, well, I bought with 5% down, and now my house went down 10%. So I actually owe 110% of my house value. I'm now stuck to my bank. I'm for better, for worse, I can't move.
Yeah, I'm stuck.
Don't assume that to be the case, because there are things that can be done. So let's have that conversation still. So I guess the big piece of advice is don't assume. Pick up the phone and call a professional.
Yeah, but I mean, let's, by way of example here, some of the things that could be done are working with an alternative lender, because coming out of the bank, if need be, to deal with debt or whatever it might be, might involve moving you from A to B to private, right? And having an alternative option that might even be, okay, obviously if we're talking 90% loan to value, that's not going to work. But if there is still some equity left in the home, 80% loan to value, you need to get rid of some debt, there's still options for you, because your mortgage renewal is going to impact your rate. And if your rate goes up and you're at 80% loan to value and you have debt, well, you're paying, let's say, $1,000 more a month for your mortgage. You still have the debt payments. How are you going to survive? You still need to look at options that might be, do I take out a second mortgage in order to consolidate my debt, to increase my overall cash flow every month and pay down my debt, right? Looking at options, because, well, what's the alternative?
Well, the way I kind of do it myself in my conversations is value comes later. Value comes last. First, tell me about your mortgage. Tell me about your situation. Yes, tell me about other debts. And we say debts, but I would say other borrowing needs, because I don't want to pigeonhole whoever's watching or listening to think refi means pay debt.
No,
not necessarily, right?
No.
So refi could be some sort of an investment you have coming up. Maybe you want to fund your kids' education. A refi could even be not borrowing any money, but perhaps, you've been hammering away at the mortgage. You've gotten your amortization down to 18 years, but 18 years at 1.89% is a manageable payment. Now, 18 years at 4.29%, for example, you're like, holy smokes, I won't swear. That payment, I don't know now.
Yeah.
So you could refinance to extend the amortization.
100%. And a lot of people are doing this. It's actually something that, and again, I'm not going to take us down a rabbit hole, but it's something that I'm telling a lot of people that you should consider, because we're talking about affordability. We're talking about being able to afford the home that you're living in and not having to sell in a down market. Let's be real. Right?
Well, and let me finish my thought, because what I was working towards was, that's the conversation we start with. So what's going on with you? What other obligations do you have? It also depends on life stage, right? How old is the person sitting in front of me? Because that then tells me what's going on in their life. What's the next milestone that they're going to hit? You with your boys, for example, are going to be different than me with my kids. My kids are a lot younger. So I want to also understand what's the life stage that person's at. Are they 60? Are they 45? Different things are going on at that stage of life, and therefore different borrowing costs. So I first like to have the holistic conversation, understand their situation. What do you got in terms of savings? When do you want to retire? Any other obligations bogging you down? How old's your car? Son, daughter, off to university? How long? Getting married? That sort of thing, right? Then I like to get to the house value. So first I want to understand, like, what are we working with? And then do we have the house value to support what we maybe want to do? And then if we don't, well, that's when we need to look at alternatives possibly.
So we're looking at creating the right plan, setting expectations for the client on what the best, I shouldn't say what the best, but setting expectations. Maybe that's not the right word. Maybe it's not expectations, but setting the client up with the right plan to help them move on and have stability with their financial future?
Yeah, I would even, I might call it refocusing their attention.
Oh, I like that one. You know I'm big on attention. Thank you.
Because how does your average, people in the industry, how does your average new client introduction who's coming to you for a renewal, referred by someone, however they got to you, how does that conversation typically go, that first phone call? For me, in my experience, it's usually my mortgage is coming up for renewal. Joe Blow said you could help me, so I'm giving you a call to see what you can do. I was offered this rate by my bank. What's the rate you can offer me?
Yeah.
That's, correct me if I'm wrong, but a lot of conversations start like that.
Lou, we both know the reason why people are asking for the rate is because that's all they know to ask. They're not coming to you to say, hey, Louis, can you create a financial plan for me for my mortgage? It's going to help me. No.
Well, to a lot of people, I mean, I used to ask this question to clients, but also in my previous life, I supported, frontline salespeople at banking centers, mortgage advisors. And when we'd get so fixated on low rate, I would ask, what does low rate mean to your client? What are they actually asking you for? And we'd kind of play that game where it's split it off into two. And you've seen me do it in meetings here with our agents and brokers. Like low rate, if you're trying to overcome an objection or at least just focus someone somewhere else, what does that mean? And then they look at you like, well, what do you mean? Usually you get the silly answer, which is, it's in the same thing. Like low rate means low rate, which is a non-answer answer. Okay, but break that down. And I usually funnel you into two categories, as you know. Low rate either means I want a lower payment. Always. So I want to pay less every month. In which case I now put you into a cash flow as a concern bucket. The other client, low rate, might mean I need to pay this mortgage. I want to pay the mortgage out as quickly as possible. So to me, low rate means I'm going to get rid of this mortgage faster. That's a different scenario. That's a different bucket I place them in. I'm still going to ask my follow-up questions, but already that person probably doesn't have cash flow issues if they're asking about paying the mortgage quicker. So then we might look at a strategy on maybe not just rate, but your goal is to pay the mortgage off as quickly as possible. Let's look at how to do that.
Maybe that's a HELOC option, looking at different possible solutions that'll give them flexibility.
Maybe it's a client with multiple properties if they're doing well, and there's other things that we can look at there, right? And again, maybe that's someone with an expense coming up, but they're the old school mentality of pay my mortgage, pay my mortgage, pay my mortgage. So that's a different conversation. So first thing is refocus that person who comes in with just, my mortgage is up for renewal. I got this rate. What's your rate?
Speaking about options, who's really in your corner during a renewal process? A banker or a broker?
I feel like this is, you're leading me here because
well, let's talk about it. If you ask
a banker, they'd probably say me, and then you'd be like, why?
Well, let's be
real.
Tell me why. Bankers, we have the honest conversation. Bankers work for the bank. I mean, it kind of says it, right? But brokers work for you, the consumer. And so let's be completely transparent here. And I won't say which bank, but it was my job previously to ensure that clients renewed with said bank. And depending on the rate that we gave them would decide the bank's commissions, which ultimately determined my commissions. And we need to remember as people that, go to the banks for mortgages that they are a for-profit business. They are not your bank, as people like to say. Oh, my bank's going to give me 3.95. Okay, no problem.
Maybe they will.
Maybe they will.
But in a lot of cases, that's about all they're going to do at that point.
But yeah, the alternative, the other side to that is walking into your bank and going online to review the offer that's coming in from your bank is really the only option that your bank, in quotes, can offer you, because that's all they offer. But working with a broker, as we both know, we have access to a crap ton of lenders. And we're looking at what's the best option for you, the consumer, for you individually, for you and your family, to ensure that you can afford the home that you're in moving forward. And I'm not sure you're getting that same level of care just walking into the bank or logging in online, just being honest.
I was waiting for you to finish because I love this topic. I'm a man of passion, as you know.
I'm going to give you 2 minutes.
2 minutes? I can't get this out in 2 minutes. Okay, I'm a man of passion, and I'm passionate about this. So banker versus broker. I do agree with everything you said. Let me add to it. So we both came from the bank. A lot of the top brokers in our industry, I think, come from the bank as well. So certainly not a knock on the bank.
No,
a lot of people earn their stripes there and then sort of move up to the big leagues, to sound a little bit arrogant, but it's different. Like, when you're on that side, you think you know a lot, and then you move over here and you're like,
I know one thing.
I'm learning different aspects now. So when you have a renewal at a bank, number one, there's so many different departments at the bank. So who are you dealing with? Because as you said, there are people that are specialized just to renew that mortgage. Now, they're not qualified to give advice. These are unlicensed mortgage professionals. Again, not to knock them. They have knowledge, but their number one priority on their scorecard is to get you to sign on the dotted line to renew. In a lot of cases, believe it or not, you may even want to stay with that bank. But if you want to borrow money, refinance, because you've identified by yourself that you need to do something, it actually goes against their scorecard.
100%. It used to hurt me. It hurt me. Let's be real. Again,
so you refer them to someone else because they actually need to do something.
Yes.
But it actually hurts your bottom line.
Yes.
So you're potentially sitting across someone who maybe doesn't have the moral compass that Clyde Bryant from 2008 had, right?
Oh, way
so
back
they
then.
would rather, I need you to sign here because that's how I feed my family.
Yeah, exactly.
So there's a little bit of conflict when it comes to that if you're in certain departments. Or what I would see a lot is your financial advisor would handle your mortgage. Now, there's a lot of good FAs out there, but the issues that can arise there, I can tell you firsthand, a lot of FAs are focused on the investments.
The majority are.
Their mortgage knowledge,
it's limited.
They outsource it.
Yes.
So it's limited. Again, there are FAs that have credit as a background, but
they're not mortgage professionals.
And you don't know who you have, right?
Correct.
Because as salespeople, you're going to project confidence when you're sitting across from your client, regardless of whether or not you know the mortgage inside and out, or you have to pick up the phone after the client leaves and say, okay, this guy, he threw this at me, I need your help, kind of thing. So you don't know, even if you have an individual that you trust with maybe other aspects of your finances, they're not necessarily a mortgage expert.
Correct.
So
No, Lou, let's be real. To work in a bank, you are not required, in fact, you do not have a mortgage agent or mortgage broker's license. Period, hard stop.
Yeah, they're covered by the Bank Act, so it's not necessary.
Correct. And if I'm walking in, let me take that back. If I am looking for options, you're not going to get options from a place that only offers one thing.
Never mind options. How can they give you advice? The people I just described, how can they give advice? No knock on them.
No.
They can't.
They can't.
Not as it relates to restructuring your mortgage.
It's not what they
and
do.
even if you get the individual that that can, because I came from the bank. I like to think that I could do what I could do. That's when options comes in, because now I can do something for you, but I have one product I can offer you. So I'll do the best I can. Kind of fit you into this.
I fit you into the box.
You know, and maybe for your most straightforward of straightforward clients, like it's fine. And that's, listen, this is the Burger King and McDonald's on the corner thing, right? That's fine. They're there. They service the client's need, and that's it. But how can they offer you advice if it's maybe not an individual who has the background? And then even if they can't give you options. No. They can give you their option. And hopefully that option's a good option for you as the client.
Yeah, versus brokers where we have multiple options.
You have a lot of options, and it's more about, let me understand your situation first, then I will go find you the suit that fits. Not trying to fit you into my suit.
Which
as you know,
I'm not
don't even... This is not the time or place to discuss my fall from grace as it pertains to fitness. But just know that I got a membership and I'll be back.
All right. Hey, I'll take it. So here's something that we're seeing a lot more often today. Clients that were once A business that are now B business, and clients that were once B business having to look for alternative options.
Yeah. Alternative, private potentially. You want to let me run with this one?
Sure, go ahead.
Okay. We were talking about it the other day. Just an observation in doing this for a while is people who have always been approved at the bank, A clients, 15 years, I've always renewed or I've always refinanced, I've bought multiple houses, no issue, always been on the A side.
That's right.
We're finding a lot more people now, given the difficulty to qualify with higher stress testing rules and just elevated levels of debt, income not keeping up with debt levels. This select group of people is now having that difficult, come to Jesus moment that, oh my God, I wouldn't even qualify for this mortgage today.
No, I can't afford my own house.
Basically like,
that's the reality.
Lucky I bought in 2015 because this mortgage I literally have right now, if I applied today for this same mortgage, I would be declined.
Yeah, which is crazy, but true.
So that's the backstory. And what I was saying that I've observed was cosigner conversations for me in my business used to be the domain of purchase transactions. So typically younger, maybe couple,
I had
or
a
individual.
Cosigner. My mom was my cosigner when I bought my first house. Right?
You're fortunate. God bless her.
Thanks, Mom.
Not everybody has that, but that used to be a conversation you'd have with a younger audience, and it was typically a parent or someone older that would come on the mortgage to help them qualify to buy the house, and then we would strategize eventually, how do we get them off this mortgage? Because they helped you out, but now you're establishing yourself, your income's growing, life changes, and the end plan is ultimately let's get them off the mortgage, which ironically used to be at renewal.
Yeah, exactly. I remember
it's kind of flipped.
I was saying, I remember when my mortgage was coming up for renewal on my first home. And actually, I can't say I remember. My wife kind of remembered the renewal was coming up on the first home because she was like, hey, by the way, so, and your mom, she's coming off title, right? Yeah. Okay. Yeah. Just make it.
Yeah, that sounds about
right? Well, it's the awkward conversation, but one that many were having.
I don't even know why it needs to be awkward.
I don't know why
you wanted her off. Your wife wants her off, and I guarantee you your mom wants her off. Why does it have to be awkward? We all want the same thing.
We all want the same thing. I'll go get it done.
Who's gonna like broach the topic first?
Exactly. Awkward family dinners.
Broach?
Yeah.
Broach.
Approach. Who knows?
Broach, whatever. So that's flipped though. Don't you notice?
Yeah.
I'm having conversations with people who are up for renewal and all they want to do is extend the amortization. Like I need a lower payment. I have like maybe 10 grand worth of debt. My savings is a little bit depleted. Kids are in sports.
Kids are in daycare, and I can't afford my mortgage payments to go up by $1,000. Lou, help.
Okay. Now we put an application together and it starts to become evident that we're in that position that we just joked about. Oh my God, I don't even qualify for this mortgage anymore. So now the cosigner conversation starts to take place at renewal, not at purchase anymore. and it's different. It's a different audience. It's our age, right? It's someone in their early 40s, mid 40s. Hey, you need a cosigner if you want to continue to stay on the A side. Do you have someone? And that possibly now leads into bigger conversations because
early inheritance.
Who would they be?
Family
would
planning.
be parents. Exactly. It's elderly parents who may be the baby boomer generation who is sitting on equity, but they're pensioners. So different conversations are happening now. But observation, chatting with you last week, and we kind of just verbalized it. Like, yeah, it's changed a lot. Like cosigners are now like a big part of renewal conversations.
Listen,
never before.
When I'm sitting down or talking to clients today, this is an option that I am presenting 9 times out of 10. And it inevitably leads us to, we call it family lending here at Uptown. That leads us to like a family lending conversation or an early inheritance conversation where mom, dad are saying to, son, daughter, we have equity in the home. We've worked our whole life to pay down this home either to now or close to now. And we have the capacity to either take money out of the property and give it to you as an early inheritance to maybe pay down that mortgage or pay out the debt. Or maybe, like you were saying, mom, dad are going on title to help. Or maybe mom and dad are going to lend you that money. And they're going to get that money via, whatever means that needs to be, a reverse mortgage or a regular line of credit, who knows? But this is now a much bigger conversation than, okay, my Scotia mortgage is up for renewal and they're offering me 4.14.
That's how it started. Yeah,
right?
And look where we've taken it.
Yeah, exactly, right? It's no longer just about the letter in the mail or the email that comes in, because it's just not that simple anymore.
And I'm a big fan of having a dialogue within a family about money, because sometimes there is a stigma. Like a lot of people don't talk about it, even with their own parents or children. But why? I mean, I think you'd probably find that families who through generations have done well do talk about it. And they do look at it holistically as a plan versus my parents don't know what I have and I don't know what my parents have. I'll find out when they die.
That's the worst.
That's how you leave generational wealth in CRA's hands.
Exactly.
But you leave money on the table that way. And what's the alternative is, again, people not qualifying, what the alternative is, alternative lending. Lending.
Yeah.
Where you're going to have a higher rate, more fees, and it might be manageable, but why not have a conversation first with mom and dad if you're lucky enough to have them in the picture and them be on stable financial footing before having to
look at alternatives.
Yeah.
Now, the one thing I will say, though, don't be scared of B options or alternative options, because you might have to pay a small fee to get in the door. But by paying that fee, you're going to end up with a plan that's going to work for you. And what I really mean by that is having to work with an alternative lender or qualify for that B mortgage is really just one step on the ladder. And going through that 1 year, 2 year, 3 year term, whatever it might be, while you're in that B or alternative channel is what you need to do to eventually exit. Hence why we have a plan to get you back with that prime lender. And that's okay. And for what may be 1% as a fee, maybe, that you got to pay, I don't see that as a bad thing.
No, and that's not what I was.
No. This is
the alternative. Our alternative partners, there is absolutely a need for them, for the right individuals, for the right scenarios. 100%. This wasn't a
no. Please don't get me wrong.
Do everything you can to get away from B type of conversation. It was just don't leave stones unturned when it comes to you and your family's finances.
Yeah, we're talking about finding different ways. That's what we're talking.
And there is no better time than when you are up for renewal. It's not that you can't do these things off cycle, but don't miss the opportunity. Renewal is the time where you have the freedom to possibly pivot with very little cost. In other words, no penalty for breaking your mortgage. So don't miss the opportunity. Prepare for these types of discussions now, or at least be open to them when your mortgage professional, aka me, brings them up to you.
Shameless plug.
Be ready to have that conversation. Be open. Let's put it out on the table, because at the end of the day, my only goal here is to help you find the right solution. So if I do that, then I'm looked after as well. Let's face it.
Agreed. So with all the changes that have happened, one big question remains. Should we go fixed? Should we go variable? And what I'm really talking about here is cash flow and, again, planning. So let's look at that. The pros and cons of looking at fixed versus variable in today's market. Fixed, I would say, gives you stability, gives you the option to plan what comes in and what goes out for the next 3 years, 5 years, whatever it is that you're going to have. But that's not to say that taking a variable in today's market is a bad thing, is it?
I'm Mr. Cliche, and I'm going to tell you, it depends on the person.
Mm-hmm.
Of course not. It's tough now, honestly. Like, even someone like me, like, I'm up for renewal this year, and I'm like, what do I do?
Yeah.
And I'm plugged in, for lack of a better term. But still, I'm like, what's important to me here?
Flexibility. If we're talking variable, we're talking about flexibility. We're weighing flexibility over the potential risk of an increase over the course of your next 5-year term or 3-year term, whatever it is that you're going to take as a variable. And
yeah. And sorry to cut you off. I'm the example I'm giving, just so people don't think I'm just pulling this out of where. I'm considering, my wife's on mat leave right now. How does that play into what term I take next? When does my son go off to kindergarten? So if I take variable, how's that going to look if there's a shift versus fixed? What's that payment going to look like?
Exactly.
And when does he go to school? How?
Well,
so
that's planning.
I'm having these conversations with myself in my own head, because nobody else will listen to me. But these are real things that, like, even me as a client, I'm thinking about. And if I was not in the industry, I'd probably put them on the table for you. And I'd say, here's what I'm going through right now in my mind. Like, what do you think? And then a lot of what we do is just
hashing out scenarios. Let's be real.
And trying to identify what type of personality do I have in front of me, right? Because you have people that come in and they ask all these questions about variable, but like, you're like, this is not a variable person.
Like fixed income, inability to handle payment increases, all those things that might negatively impact your cash flow are reasons why, if you have a fixed income with absolutely no options, no savings, and no support, I would stay away. And
by the way, the other type exists too, where they're like, I just want fixed. And you look at their profile, screams variable.
Oh my God.
And you're like, I don't understand. Like, why? Like,
well, listen, one thing I will say to you is, as much as I am I'm not gonna say I'm super not risk taker. Let's just be very, 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 very honest. And being the not risk taker that I am, when rates were super low, I didn't take the variable. I did the complete opposite. I said, well, rates are low. I'm going to lock in my fixed rate at 1.95% for the next 5 years. And let's be real, thank God that I did. Because I could now...
bragging about your decision.
Well,
get out of here.
What we're really talking about is I didn't have to worry about fluctuations in my cash flow. What it allowed me to do was pay down my mortgage. And now that I'm coming up for renewal, I'm looking and I'm saying, okay, what can I get? What's the variable at? How do I feel? Where am I from a business perspective? Where are my kids? How much money do I need? And what happens if, right? Because, and I'm not going to make this a political conversation, but, I still remember watching the news and watching Justin Trudeau say, rates are low, they're going to stay low for the foreseeable future. Well, what a crock that was.
Don't get me started, please. This is a public podcast. People don't know me. People who do know me know what I'm thinking right now. But anyway. Yeah, but you made the right decision. You know, a lot of people, though, it wasn't enough, 1.92. And a lot of it goes back to what we talked about at the beginning. They already were stretching themselves at 1.92. So but I can get variable at 1.67. Then my payment's a touch lower. Not thinking this would ever happen. And sadly, that's a whole different podcast. Those are the people that are in real trouble.
Yeah.
If they've even made it to 2026 kept the home, right? The more difficult conversations, I had them a year and a half ago with people when variable prime was 7.2%. And they're like, but why would I take variable now? It was sort of, because for a long time, variable, I literally didn't, too much unknown. It's going up for so long. And then we sort of felt like we were at the top, and, you know, we had clients that were fine. They can qualify. Fixed was 5.69 and variable was 6.3, 6.4%. And we're being asked, what do you think? What would you do here? And if you ask me what I think I would do, I'm going to tell you what I would do.
Yeah, of course.
And then I would say, but I'm not like you, or you're very similar to me. But, you know, I put my disclaimer out there. So it paid off on the other end for some people as well. Fixed rate clients that I sort of said, why don't you be open to this? Because what's probably going to happen, if we listen to all the economists out there, is we don't know when, we don't know for how long, but there's likely going to be a decrease over the next couple of years with variable. And lo and behold, thankfully, we don't always get it right, but we have clients in our book of business here at this brokerage where they maybe needed to be persuaded to go variable when things were higher, and now they're in the mid threes versus signing at that 5.69 that they'd still be in today. That's not everybody. That's not, you know, that's not your game plan, your go-to script for every single client. But those are renewal conversations. Those are, like, just to put a bow on it and bring it back full circle. Like, I could have just said, which one do you want? This one? Get you approved? That underwrite the deal? That's easy. But those are the renewal conversation. What else is going on here? What do you think? I'll tell you what I think. But at the end of the day, all I'm here to do is facilitate through education your options and maybe nudge you to one or the other to improve your financial position.
So, bottom line, don't just renew, plan.
Yes, sir, for sure. For sure.
So, in closing, here's what I'd say. When it comes to your upcoming renewal, this could be your biggest financial opportunity that you might have for the foreseeable future. So don't wait, start early. And if this podcast resonated with you or someone you know, in fact, if you heard someone say the word renewal, share it with your friends, family, and of course, like and subscribe. Lou, thanks for coming. Tell the people where to find you in case they're looking to ask some mortgage questions.
Well, I wasn't prepared for that. You can find me on socials, Facebook, Instagram. Search my name, Luigi Cirocco. You'll find me.
Perfect. And as always, I'm Clyde Bryant. Thank you for watching. Uptown Experts, we're out.